5 lessons we should have learned from the crisis. The economist Joseth E. Stiglitz shows this in an article in China Daily. 5 lessons we should have learned from the current crisis. Lessons that if things do not change much in 2010, we have the opportunity to relearn in the future next. Oh, the market corrects itself. In fact, without adequate regulation, the market has a natural tendency toward excess. Simply, the Adam Smith's invisible hand does not exist. The bankers pursue their own interests that need not fit with the general interests of society, including need not fit neither with interests of its shareholders or borrowers, and certainly are not the same interests as owners who have lost their homes, workers who have lost their jobs, retirees who have seen their pension funds evaporated, or taxpayers who have paid billions of dollars in bank bailouts. Under threat of collapse of the system, network security has not served just to save individuals from the demands of life, but have extended generously to save the commercial banks, investment banks, insurers, or car companies. Not much money had been transferred, so many to so few. The rationale has been to rescue the banks, would be reopen the tap of the loan. This has not happened. What has happened has been simply that the taxpayer has given his money to institutions that they have been speculating for years through predatory lending, interest and usurious credit cards, and fees are not transparent. The rescue plan has exposed one of the greatest hypocrisies of history. Those who hid behind fiscal restraint when it came to financing small welfare programs for the poor now have no problems defending the biggest bailout in history. Those who advocated the virtues of free markets and transparency have led to an opaque financial system so that neither the banks themselves understand their balance sheets. Those who defended the responsibility now seek forgiveness of debt for the financial sector. Oh, the second lesson involves trying to understand why markets often do not work as they should. There are several reasons for market failures occur. In this case, financial institutions too big to fail have perverse incentives. If your bets are successful, they keep all the profits. If they fail, it is the taxpayer who pays the party. When information is imperfect, the market is not functioning well, and imperfect information abound in the financial market. Oh, third lesson, Keynesian policies work. Countries like Australia have implemented large, well-designed incentive schemes, are emerging from crisis. Other countries that have succumbed to the old orthodoxy. If the economy goes into recession, is the deficit, tax revenues fall faster than costs. The old orthodox economic policy argued that this gap must be cut, either by raising taxes or cutting spending. Either action reduces aggregate demand and pushes the economy into a deep depression and further undermine confidence. Oh, fourth lesson. There must be something more than just monetary policy to fight inflation. An excessive focus on controlling inflation by central banks causing them to ignore what is happening in financial markets. The cost of high inflation is minuscule compared to the cost imposed on an economy if the central banks cease to flourish speculative bubbles. Oh, fifth lesson. Not every innovation leads us to have a more efficient and productive, not to mention a better society. Private incentives matter, and if not aligned with a social return, the result may be to take excessive risks, and short-term behavior predominates. For example, the benefits of innovation in financial engineering in recent years are difficult to prove. What has become clear is that the cost associated with them has been enormous. Of all the lessons, I'll take the fourth, because the theory is that it is easier to remedy. It just depends on the will of a handful of people with a very difficult task, but supposedly very intelligent. So far it seems that still not learned his lesson, quite the contrary. Not only are with zero interest rates, but have started to unseen monetary policies, such as quantitative easing. The excuse is that there are currently no signs of inflation. The problem is going to create another bubble that will take more or less but will explode.